Very good morning to all of you. Welcome to Tanushri YouTube Library, Simplifying Your Success. Friends and my dear students, if you like this video, press the like button, and if you did not subscribe my channel yet, please do subscribe, and don't forget to press the bell icon to get the video notifications on your fingertip. So today we are going to discuss one of an important topic in our fourth chapter. I am Manju B Assistant Professor of Commerce, Kodachadri Government First Grade College, Pasanagar, Shivamoga District. So friends and my dear students, we will discuss regarding the taxable capital gain in special cases. Okay. Before going to that problem, let me correct myself. That is, in the last class, what we have discussed the problem which is appeared in the question paper of the Coimbatore University in the year of May-June 2017 for 15 mark section. There is one correction which I have to made. In case of the second house property, the indexed cost of acquisition has been provided 2 lakh and indexed cost of improvement is 51,000. There is a mistake in typing of the figure in case of indexed cost of improvement. That comes to rupees 1,26,372 when we do the indexation of the cost of improvement of rupees 51,000, and that is 51,000 multiplied by the current year index, that is 280, and divided by the index of the year of improvement, that is 113. I apologize, and I guarantee you that these kind of the minor mistakes will never happen again. So let us go with the today's class. The capital gain in case of the special cases. The first one special case is if the capital asset is purchased by the previous owner and it is acquired by the taxpayer before 1/4/2001. That is both the cases, that is purchased by the previous owner before 1st April 2001 and acquired by the taxpayer before 1st April 2001. In these kind of the special cases, what can be the treatment of the capital gain? So we are going to discuss in this class two special cases. Hope that you're gonna understand these special cases. Okay, so let us go with the problem. So here comes the problem. First part, Mr. Bhandari, who is resident, purchased a residential house in Delhi on 1/4/2000 for rupees 1,50,000. On 1st May 2000, he gifted the house to his son, Mr. Vaibhav. Mr. Bhandari constructed the first floor of the house in December 2000 at a cost of rupees 50,000, and Mr. Vaibhav made improvement in the house and added 2 rooms at a cost of rupees 50,000 in June 2005. So this is the first part of the problem. What they are saying, the house property was acquired by the original owner in 1/4/2000 for rupees 1,50,000, and on 1st May 2000 it has been transferred from original acquirer to the taxpayer, that is to Mr. Vaibhav, who is the son of Mr. Bhandari. And Mr. Bhandari has constructed a house additional floor in December 2000 at a cost of rupees 50,000, which we are going to ignore. Why? Because the improvement is made before our base year, and there is one more improvement which is made in the year of June 2005 of rupees 50,000, which we have to consider. This is the first part. Second part, Mr. Bhandari died in December 2010. So the acquirer, that is the owner of the original asset, is died in December 2010, and Mr. Vaibhav sold the house on 1st August 2018 for rupees 30 lakh, and the brokerage paid was rupees 25,000. So here the taxpayer or the assessee for us is Mr. Vaibhav, and we have to calculate the taxable capital gain of this guy, and we have to find out the capital gain or loss if the fair market value. So they have provided the fair market value also of the house property on 1st April 2001 was rupees 2,50,000, which we are going to consider during the computation of the indexed cost of acquisition. And they have provided the cost inflation index for the different years: 2001 200, 2005 6 117, and 2018 19 it is 280. Let us go with the solution. So the basic information we have to provide, that is name of the assessee, that is Mr. Vaibhav, and his residential status is ordinary resident, and for us the assessment year is 2019-20 and the previous year is 2018-19. Okay, let us go with the solution. So here comes the solution part. Here the asset is considered as a long term capital asset. Why? Because the holding period is more than 24 months in case of the taxpayer also. Okay, and the name of the long term capital asset is house property. The sales proceeds or the sales consideration they have provided. Mr. Vaibhav has been sold this house property for 30 lakh rupees, and that will be considered as the sales proceeds or the gross sales consideration. And we have to less the selling expenses if there is any. And here in this case we are having the selling expenses of the brokerage which was paid to the broker by Mr. Vaibhav of rupees 25,000. If we deduct the selling expenses of the brokerage paid 25,000, we are going to get the sales proceeds or the net sales consideration of rupees 29,75,000, which we are going to put it on the outer amount column. And this is the output of the stage 1. Next, we have to deduct both indexed values if they have provided in the problem. The first one is the indexed cost of acquisition. So here the indexed cost of acquisition is computed by using the formula of the cost of acquisition or fair market value as on 1st April 2001 if the property has been acquired before our base year. So out of these two amounts we have to consider the highest value, and here the asset was acquired by the original owner, that is for rupees 1,50,000 in 1/4/2000, and the fair market value as on 1/4/2001 is rupees 2,50,000. So out of these two amounts 2,50,000 is the higher value, and this will be considered as the cost of acquisition. So cost of acquisition multiplied by the current year index, and the current year index is 280 divided by the base year index, that is 100, and that comes to rupees the indexed cost of acquisition 7 lakh. And second one, that is the indexed cost of improvement. Whether there is any improvement? Yes, of course there are two improvements, out of which we have to consider only one, that is the improvement made in June 2005. Why? Because the improvements which are made after 1st April 2001 will be considered for the calculation purpose. And here the improvement cost is 40,000 multiplied by the current year index. The formula will be like this: the indexed cost of improvement equals cost of improvement multiplied by current year index divided by index of year of improvement. And the cost of improvement is 40,000 rupees multiplied by the current year index, that is 280, divided by the index of year of improvement, that is 117. That comes to rupees 95,726. So these are the outcome of the both indexed values, that is 7 lakh rupees plus 95,726. That amounts to rupees the total indexed value 7,95,726, which we have to deduct from the net sales proceeds. And the outcome will be considered as the gross long term capital gain, that rupees 21,79,274. So whether they have claimed any kind of the deduction under section 54 to 54 GA, there is absence of the information regarding the exemption the assessee has been claimed. So therefore the exemption under section 54 to 54 GA will be considered as nil. Therefore the taxable long term capital gain will be 21,79,274, and this will be the taxable long term capital gain for the taxpayer of Mr. Vaibhav for the assessment year 2019-20. Okay, there is one more note, that is regarding here we are having the special case of the two persons, out of which one who is the acquirer or the original owner of that property, who is going to transfer to some other person. That's why I have made the clarification in note number 3, that is the indexation of the improvement. Okay, so it can be done only if the improvement is done on or after 1st April 2001, no matter who has incurred the amount, whether the improvement is made by the father or whether the improvement is made by the son, that is the past owner and the taxpayer. It doesn't matter, only the thing is the improvement has to be done on or after 1st April 2001. Then we can consider whoever incurred that improvement cost. And one more clarification to you guys, that is if the improvement are more than one which are made after 1st April 2001, so what might be the answer? So we have to consider every improvements which are made after 1st April 2001 for the calculation purpose. Okay, so this completes your first problem. Hope that you are going to understand this special case. Okay, so let us go with the second. Here comes the special case of second, that is conversion of capital asset into stock in trade. If the asset has been originally purchased by the taxpayer, and if he is going to convert that capital asset into stock in trade for his personal business or the business which is carried by him on a certain date, then we have to consider this special case of conversion of the capital asset into the stock in trade. And here comes the simple problem on this one. A building has been acquired by Mr. Adarsh on 1st June 1980 for rupees 1 lakh. The assessee converts the building into stock in trade of his property dealing business on 1/6/2002 when the fair market value of the building is rupees 10 lakh. The stock in trade is sold by the assessee on 1st January 2019 for rupees 15 lakh. On that, the fair market value as on 1st April 2001 was 1,80,000. So a little bit confusing. I will provide the clarification for all these things. Okay, so they have provided this much of the information. This asset has been acquired for 1 lakh rupees, and the fair market value on 1/4/2001, which is provided on the last line of the first para, that is 1,80,000 rupees, which we have to make the comparison. Okay, so why? Because the asset has been acquired before 1st April 2001 and the cost of acquisition will be 1,80,000. Okay, so remember this one point. And here comes the solution, that is the computation of the taxable capital gain. We have to provide the simple information. The name of the assessee is Mr. Adarsh and his residential status is ordinary resident, and the assessment year is 2019-20 and the previous year is 18-19. Okay, so I have provided one note here, that is note number 1. In this special case, the special case like the conversion of capital asset into stock in trade, the fair market value on the date of the conversion of capital asset, when the capital asset is converted into stock in trade, on that date whatever the fair market value has been provided should be taken as the gross sales consideration. Remember this point. This will be helpful in case of the computation of the business profit. Why? Because they have asked to find out the capital gain and the business profits which is taxable. Okay, so remember this point. Further, the sale of such stock taxable as business profits in previous year in which the stock has been sold. So remember the basic point, that is if the asset has been converted into stock in trade, then whatever the fair market value on the date of the conversion of that capital asset will be considered as the gross sales consideration rather than the sales price of that or the sales consideration to which the asset has been sold. Okay, let us go with the solution. So here comes the solution for the special case 2. Here the asset has been having the holding period of 1st June 1980 to 1st June 2002. So that's why it will be considered as long-term capital asset. So we will refer into note number 2 what they are going to provide. Note number 2 says holding period will be from the date of acquisition, that is the date of acquisition of this asset is 1st June 1980 to the date when the original asset converted into stock in trade. When the asset has been converted, that is on 1st June 2002, this asset has been converted into stock in trade for his business, and this will be the period of holding. So based upon this period, that is from the date of the acquisition and to the date when the original asset is converted into stock in trade, that period will be considered for the consideration of whether it is a short-term capital asset or long-term capital asset. So by considering this note, we can say that this capital asset is a long-term capital asset. So let us go with the gross sales proceeds or the sales consideration. What I have told, that is, if in case they have provided the fair market value, whatever the fair market value they have provided in case of the capital asset, so that will be considered as the gross sales proceeds, and the gross sales proceeds will be considered to rupees 10 lakh, that is the fair market value of the building. Okay, so 10 lakh rupees, and we have to less the selling expenses. There is the absence of the selling expenses, that's why it will be nil. Therefore the net sales proceeds or the net sales consideration will be 10 lakhs, remains the same. And next one, we have to do the indexation, that is indexed cost of acquisition and indexed cost of improvement. Indexed cost of acquisition, they have provided the information regarding in note number 3. So how we are going to find out the indexed cost of acquisition in case of the special case where the capital asset has been converted into stock in trade, and here comes the note number 3, that is indexed cost of acquisition equals the cost of acquisition. What is the cost of acquisition? That is the fair market value or the cost of acquisition, whichever is higher, right? So they have acquired this asset for rupees 1 lakh, and the fair market value which is provided on the first para, the last line, that is fair market value as on 1st April 2001, that is 1,80,000. And here the out of two amounts, 1,80,000 is the higher value, that's why we have to consider 1,80,000 multiplied by cost inflation index for the year in which asset is converted into stock in trade by the assessee. So here comes the practical problem, that is we have to consider the multiplier of the cost inflation index, not of the current year but of the year in which the asset is converted into stock in trade, and the asset is converted into stock in trade in the year of 2002-3. So for 2002-3 the cost inflation index is 105, which is considered as the numerator, and divided by the cost inflation index for the year in which the asset was purchased by the assessee. The asset was purchased by the assessee in the year of 1980. So there is an absence of information. So for that purpose we are going to consider the base year index as a denominator here. Therefore 1,80,000 multiplied by 105 divided by 100, and that comes to rupees 1,89,000 will be the indexed cost of acquisition. And the indexed cost of improvement, they have provided absence of information regarding any kind of the improvements made after 1st April 2001. So therefore the total indexed value will be 1,89,000, and therefore the result will comes to notional long-term capital gain, or we can say that the taxable long-term capital gain also. This is a special case, that's why we have to use the notional long term capital gain of rupees 8,11,000, which we are going to get by deducting the indexed value from the net sales proceeds or the net sales consideration. This is the first part. In the problem, they have asked to find out not only the taxable long term capital gain but also the taxable business profit also. Okay, so business profit is going to be calculated by using this simple two-stage step. That is, first we have to consider the sale price of the stock in trade sold, whatever the amount that stock in trade has been converted, and that converted value is going to be sold on certain price, and that price is going to be considered as the sale price of the stock in trade. And they have provided in the problem, this asset has been sold on 1st January 2019 for rupees 15 lakh, and that will be considered. And we have to less the cost of acquisition. Here also the same case, the cost of acquisition will be considered whatever the fair market value on the date of the conversion of the capital asset into stock in trade. I have provided in the previous slide in note number 1 that will be applicable for the gross sales proceeds and the cost of acquisition for both these things. Okay, so the cost of acquisition is 10 lakh, therefore the taxable business profit, that is the second part, that comes to rupees 5 lakh. Okay, so this completes the two steps of computation of the long term capital gain and the taxable business profits. The combination of both this or the addition of both these values will be considered as the total income being taxable, that is the combination of A plus B, or simply we can say that the total income taxable under the head income from capital gain, that amounts to rupees 13,11,000 rupees. And this is the final answer. So hope that you have understood both the special cases. Okay, so if you are having any doubts regarding this, you can text me or you can comment me on the comment section. So for you guys, the assignment problem, this is my first assignment for you guys. This is based on the special case number 1. Okay, so by keeping that reference, you have to do this problem. Assignment problem says Mr. Ashok purchased jewelry on 1st January 1972 for rupees 2 lakh, and there are some more information which you have to study, and you have to do the problem, and you have to tell what is the taxable capital gain and the business profit and the combination of both these things, and you have to provide the note also. Okay, so hope that you are going to do this problem. By hoping that, I am going to end this chapter. If you want some more problems, please do comment. Okay, and if you like this video, I am saying once again, please press the like button and subscribe my channel for the next chapter also. Thank you very much and all the best.